As of May 1st, 2026, the United Arab Emirates has officially ended its 59-year membership with OPEC, removing 12% of the cartel's total production from unified control. By walking away, Abu Dhabi has unlocked nearly 1.8 million barrels per day of previously restricted spare capacity, a volume worth roughly $50 billion in annual revenue that is no longer bound by Saudi-led quotas. This isn't a diplomatic spat, it is a calculated liquidation of the old energy order. Today, we map the fallout of the OPEC fracture on the 5 pillars of the global economy. The UAE is no longer playing the loyal brother to Riyadh. They've invested $150 billion to pump 5 million barrels a day, and they refuse to let a quota sit on their ROI. By exiting, the UAE has effectively become the Switzerland of oil. They are now unconstrained, sovereign, and aggressive. They've traded regional unity for absolute market share. In the new landscape, Abu Dhabi isn't a member, it's a competitor. For Beijing, this is the Goldilocks scenario. China is the world's largest importer, and a fractured OPEC means cheaper, more abundant crude. But the real win? The Petroyuan. Without OPEC's dollar-only mandate, the UAE can now settle massive contracts in RMB. China isn't just buying oil, they are buying an exit ramp from the US financial system. Every barrel the UAE pumps outside of OPEC is a nail in the coffin of the 1974 petrodollar agreement. Washington's reaction? A quiet, calculated smirk. The fracture breaks the Saudi leverage that has plagued US presidents for decades. By providing the UAE with dollar swap lines, the US has effectively bought a high-capacity ally to act as a spoiler against price hikes. It's a classic divide-and-conquer move. The US gets lower gas prices and a weakened Saudi rival, but they're playing a dangerous game with currency hegemony that might haunt them by 2030. Riyadh is now the king of an empty castle. For years, Saudi Arabia bore the brunt of production cuts to keep prices high, only to watch the UAE and the US steal their customers. With the fracture, the Saudi Vision 2030 faces a liquidity crisis. They are forced to choose: keep cutting production and lose influence, or flood the market and crash the price. The UAE's exit didn't just take away a member, it took away the Saudis' ability to scare the world. The bottom line? We are entering the era of volatility. The global economy is shifting from a managed market to a free-for-all. Lower energy costs might fuel a manufacturing boom in India and Southeast Asia, but the price is the end of stability. The OPEC fracture is the start of a multipolar energy world, where oil is a weapon, currency is the battlefield, and the old rules no longer apply. The cartel is dead. Long live the market.